Okay, well, good afternoon, everyone. Thank you all so much for attending our webinar this afternoon, the Donoghue Forlines Yield Enhanced Real Asset ETF, DFRA. And along with a very heartfelt thank you, we have prepared what we think is a very significant deck, specifically in this time frame in here. And what's so interesting around when markets really get tumultuous and the compounding effects of that tumult is that the value of non-correlated assets just really rises to the occasion almost every time. So, with that as a central theme, it's a pleasure for me to introduce to you two of the finest PMs we have in the industry. John Forlines, our award-winning Chief Investment Officer. Along with that work is also a professor of behavioral finance at Duke University, and also does very significant work, philanthropic work, not only in the U.S. but also abroad. Along with John is Nick Lobley, one of our senior portfolio managers. Nick's been with the firm really side by side and lockstep with John for the past 5 years, particularly in risk analysis and ETF selection. So we're going to hold the questions towards the end of the presentation here, everyone. But thank you for being with us today. And at this point in time, we're going to turn it over to John and Nick. So thanks so much.
Kurt, thanks so much. Always good to hear your voice, and appreciate all the work you're doing in the field. I wanted to first kick it off, and Nick and I are going to walk you through this opportunity. Just as background, most of you know that we've been working for the last 3.5 years to build a completely proprietary model that contains all the research and all the factors that we have always invested in at JF Global and now Donoghue Forlines. So there's historical precedence for us, as you know, from offering the solid products that most of you have encountered, like global tactical allocation. We felt like the off-the-shelf products that were out there had sort of a limit on your ability to customize, to be sensitive to what all the elements that we wanted, and therefore we've come up now with our final product, which is DFRA, and it fills a huge need in the marketplace, as we're going to walk you through. As Kurt said, the world has changed pretty dramatically since the pandemic, and we're now experiencing for the first time in decades a very persistent inflation. And we're not going to really get into the debate on whether or not this is going to last for a long time. All we know is when inflation hits, as it's hitting now, it's incredibly painful. And so typically, if you look at what we're experiencing now, we're not necessarily on our way to the very gory days of the early 80s, but until several things occur, including the supply chain dynamics, until they improve, and also, frankly, until the conflict in Europe gets resolved, or at least is tamped down, inflation is going to be a headline topic for a lot of people. Now, the backdrop also is interesting, is that we're still in an era of low interest rates, and if you poll 100 economists prior to the outbreak of hostilities in the Ukraine, you would have had 99, maybe all of them, who would have said, "Gee, central banks are going to really be dramatically tightening," against that chart you just saw, which is a very hard spike in year-on-year inflation. But that's really not where we are right now. We're in still a weakened, fragmented economy since the pandemic. It's recovering, but there's still many different sectors, like transportation, for example, like leisure, which really haven't recovered, the restaurant industry. So you have this mixed outlook. And on the other hand, you have some industries, on full bore, like some of the industrials, and for sure some of the consumer companies, consumer staples. And that inflation, which we saw in the other chart, is starting to creep into, and really impact the consumer, particularly on oil. And that's, the backdrop is the central banks are sort of in a bad place. Do they tighten now and therefore create worse liquidity in time when particularly EU countries need to be responding to aggression and probably helped out by the United States? And also, do they tighten dramatically in a backdrop of a fairly large current deficit in lots of places caused by the pandemic, handouts, and all the emergency aid? And to even further complicate the question of, how do I pick products for my portfolio? In our case, in your case, what if I, for example, want to invest in your own models of ETFs? How do I choose them based on what's going on now? Well, one of the reasons that we've always been in the model business is because we believe that we not only now we have the products, but we have the expertise to blend them together. And one of the things that we're seeing this year, which is of course the opposite of last year, is we're seeing basically that stock valuations where elevated are starting to come off. And what that generally means is, for example, in this case, we kind of laid the scene out, is when you have volatility and you have persistent inflation, real assets tend to outperform. And that's exactly what's happened this year, particularly with our product and also other products which are related to alternatives. Now, we're going to get into some of the details about DFRA, but one of the things that I always like to think about is it's not, it's hard to come up with specific definitions of what it means, but it really means is not only should they be somewhat non-correlated, but also they should perform well in times that we're in, like, which of course is high inflation. And that includes things like real estate, infrastructure, et cetera. So if you take a look at the question of correlations, you'll see that typically we've been in what I call a bull asset for particularly dollar assets, where for many years bonds and stocks started to move together, and that's basically because we were in that era where it was incredibly low rates and there was growth, and we had essentially a situation where the whole world was looking for dollar assets and dollar exposure. Then particularly back in the 90s, when China and some of the emerging markets started to come along, the old bonds hedge started working better. And so what we think is that you do need to hedge bonds and equities. It was not easy at all in prior bull market times, but it's much easier now, and that's another reason to have these non-correlated vehicles like DFR in your portfolio. Okay, and so I'm at this point, the next slide I'm going to turn over to Nick, but let me just kind of introduce the concept to you of why you should invest in DFRA. One, it's first of all, you should have a core allocation to real assets. We've said in the past you should have, given in even big bull markets, where stocks and bonds are doing particularly well, you may still want to have, say, 5 to 10% in your portfolio, but now you may want to have even more. And the other thing that diversification gives you is not only that hedge to inflation, but you need to have income generation, and that's another piece, I think, a really outstanding piece of how DFRA is constructed, is it does supply income because it invests in things like real estate, which often throw off income for folks, as well as master limited partnerships and things like that. And basically, our screens, as Nick's going to walk you through, it's really designed to find companies that provide long-term alpha, and that's really super important. If you're dealing with, particularly in a class of securities that often hasn't done that, you want to make sure you have screens that can achieve that. So I'm going to, Nick, I'm going to turn over to you, walk us through some of the dynamics here of the product, and I'll come back a little bit later.
Perfect. Thank you, John, for setting up the macro behind, why we really designed this product, and as, asset allocators, how it fits within our proprietary portfolios, but also, as a standalone, right? As an asset allocator, we built this to be a diversifier within our own portfolios. And, we think, rep PMs and other managers, should seriously consider adding real assets to their portfolios as a diversifier, but also a protection against inflation and an income generator, right? A quality income generator. So just, a good place to start when discussing this product is, how do we define real assets? And you've probably heard a ton of different things, with the inflation narrative over the past, really the inflation shock that we saw in 2021, that's really leading to sort of the rate shock we're seeing now. You've heard a lot about real assets and, other diversifiers, as bonds, haven't been that in your portfolio. Really the last 2 years, ever since that secular bottom that interest rates hit during the COVID low, have bonds, hedged against U.S. equity downturns. And more importantly, some of those downturns, the actual rising real yields was the cause of volatility within assets, especially growth. When you look at the, overall composition of, a typical 60-40 passive portfolio, in a lot of ways, it's a giant momentum trade on, lower interest rates and deflation. So as inflation starts to pick back up, and historically, as John had mentioned, as inflation tends to pick it back up, the importance of real assets, becomes more important. So to define real assets, we often think it's, sort of clumsily defined by different people. But to us, it's something, a real asset is something that's tangible, something you can touch, like a bridge, a building, a commodity like gold, right? And something that has intrinsic value, right? That can be exchanged for other goods and services, which makes it more real than paper assets like traditional stocks and bonds. However, the holdings within DFRA, the Donoghue Forlines Yield Enhanced Real Asset ETF, ticker DFRA for everyone out there, instead are equity based. So we hold companies that we believe benefit from owning and operating real assets. So we own REITs, which are real estate investment trusts, infrastructure equities, oil and gas MLPs, commodity-based companies, and natural resource equities. So we believe this equity-based approach, provides diversification to our risk exposures, as well as provides income, and liquidity is also an important part of this as a macro asset allocator. And we think this helps us deliver more potential benefits than some of the illiquidities in the actual physical futures and owning real estate yourself, owning and a lot of these real assets you can't actually gain access to, right? Some of this infrastructure. So owning the companies is sort of the best you can get from a smaller perspective. So I just wanted to show an example of how real assets have supported today's modern economy, right? So below is sort of an example of an online order from the whole way from purchase to delivery. Think of this as you ordering socks off of Amazon, right? So you use your mobile phone to make an online purchase, which goes to the cell tower, which sends to the data center, which brings it to your fulfillment center, logistics center. So your Amazon fulfillment center. Then it's transported via rail, ship, or toll roads, and then it's eventually delivered to your door, right? So that entire transaction is either powered by traditional or renewable energy providers, and we own companies that are along this entire thread, right? So not just the energy, but the infrastructure, the natural resources, and the physical real estate of these logistics companies. So owning companies around across the entire supply chain that benefit from the rise in real asset prices and the diversification there as well. So the three key reasons, John highlighted it right sort of at the beginning, to own real assets is, the hierarchy point is for higher risk-adjusted returns. Looking into our data, We have higher risk-adjusted returns over a longer time period. And this is through one, diversification. Real assets have had a historically lower correlation to other traditional assets. So adding real assets to our portfolio is a way to help diversify exposure and really obtain access to an underrepresented asset category. There really is not any other ETF products out there that are providing the same exposure that we have. And I think that's one of the reasons we launched this product was new to market within this category. The second part is a hedge to inflation. Real assets have historically exhibited a greater ability to hedge inflation than broader equity and fixed income markets, which and have historically outperformed during elevated inflation. So when inflation is low to rising, and when inflation is higher, real assets have historically performed, and that's part of the construction of our product, right? We have screens that account for upside inflation, and we have screens that also account for quality and income, which is our third, right? So we believe also that real asset yields are well above broader equity and bond yields, which are suppressed within your 60/40 portfolio, and offer stable cash flows to investors. So there's a ton of quality income within this universe of companies that we designed, and we think it's an important part of the portfolio that helps it diversify. So how do we've talked a good about the screens and how the processes work. As you see, we sort of have these 5 major categories. We have sort of a unique starting universe, and I think that is one of the reasons our product is unique. But then we have screens that move all the way down that develop a free cash flow quality dividend score that arrives to get our final holdings numbers, right? So we have one of the screens is our strong free cash flow profitability, which you've noticed throughout our other portfolios. It's a primary factor within our portfolios and something we believe strongly in. We also screen for high quality of earnings and then a high dividend yield, right? So companies that are producing income. And, we think this free cash flow factor is especially important within some of the more cyclical companies that we own within DFRA, because a lot of them tend to be over leveraged. So understanding companies that have strong free cash flow and high quality of earnings are important to the construction and the diversification benefits that DFRA provides. We spoke to this before, but to put some numbers behind it, this is periods of where inflation's the U.S. CPI is over 2.5%, and as you can see, real assets have historically outperformed in inflationary environments. Global natural resource equities leading the way, but these 4 categories, outpacing both equities and bonds in that environment. And then we also believe, that real asset yields are above broader equity yields. Taking a look at where yields stand as of end of last month, as you can see, almost all the categories producing higher income than your typical global equities, global bonds, and certainly more than your money market funds. So an attractive yield certainly in these sectors. With that, I'll turn it back over to John to get into where DFRA fits in your portfolio and how other institutional investors are catching on and allocating as well.
Yeah, thanks, Nick. It's a great walkthrough of the product, and we'll leave a little bit of time for questions. But even beyond that, I'm hoping that all of you on the advisor or the fiduciary side, reach out to us if you have any further questions. So the way we kind of look at where DFR fits in your portfolio is it's the classic case, and I think this is what has separated our firm for years. Is we eat our own cooking. We won't design products that we can't use ourselves, and that's an important I think measure of credibility in the marketplace. So the way DFRA fits in our portfolio, as I said earlier, it fits in perfectly right now in a pretty large proportion to the whole asset allocation strategy we have, which includes, as most of you know, we have quality U.S. equities, quality international equities. There's some emerging markets scattered in there, We have a commitment to what I call diversified and quality innovation, as opposed to some of the vehicles that are out there. We believe in the high yield market, and we also believe that, especially in the last, as you can see, in the last 3 or 4 years, the need to have mechanisms to hedge you against interest rate rises has been important, and that's what we have in our fixed income products particularly. But DFRA fits in that category of in times, as Nick shows you, where correlations are moving the way that they traditionally work, and also in times of persistent inflation, you need real assets, and we believe it'll be an outstanding diversifier, and indeed, as you'll see in a second, it's starting to do that and has done that since we've launched it. We're not alone. Institutional investors have added to their portfolios. We always pride ourselves on, we started our firm basically on the fiduciary side, where we served a lot of institutions. So we believe that what we're bringing down to the advisor level is incredibly important. And you should have just as access to just as quality products as some of these folks do, and that's what we believe we've done with all our ETFs, but particularly with DFRA. And as you can see, it's we launched it right before the holidays and the new year, and it's done quite well. Not only those three ways that Nick and I have outlined to you: diversification, non-correlation, but it's also provided a nice, healthy yield. Again, having decent yield in an era of low rates and inflation, that's along with real asset protection. That's a pretty interesting product to have in your portfolio. And again, it's one of the reasons we designed it the way we did. With that, I think we're going to move on to
John,
questions.
Just before questions, I do want to mention that the trailing 12-month yield of the portfolio for DFRA is over 4%, and the expense ratio is 69 basis points. But we'd also like to mention that there's no more overlay fees on our model, so those are free as well. So just some housekeeping there.
Yeah, no, I appreciate that, Nick. I'm woefully poor on housekeeping. My wife will tell you that. But one of the things that Nick just said, and I do want to highlight, is that expense ratio is in all our ETFs. We gear ourselves against value enhanced products. We don't believe these are just pure off-the-shelf products, as I said. So there's aspects, for example, the fact that we go after free cash flow, the fact that we go after certain categories of enhanced factors like innovation. And in this case, we're screening for quality companies, but we're also looking for diversification. We come in lower than a lot of the real asset type vehicles, both mutual funds and ETFs, and that's again another differentiator we think we have.
Okay, super. Well, thank you very much to both John as well as Nick. And we're going to start to field a few questions that came in over the course of the presentation. And if anyone else would like to put forth some, please just go ahead and click on the box there and send them through. So, okay, this first one actually, so this one comes to you, John. Over the course of your allocation experience, is there a specific and or range of a percentage of a weight to the average 60-40 portfolio that you see advisors allocating into an asset class like real assets?
That's a great question. So, first of all, we don't. We've never thought we competed directly with 60-40 portfolios, precisely because we always felt you had to have a real asset component to your strategies. So the more we think about it, we think about if you're neutral in equities, you're around 50%, and if you're below neutral, you're in the 30 to 40 range. And if you're above, you can go in our models, you can go as high as 70 on equities. And in bonds, again, that same flexibility occurs. There's a core, a neutral weighting of around 30, and that can go either way depending on whether or not rates are hurting, or maybe, for example, credit spreads are expanding. We have the flexibility to move there. And then that leaves the 10% neutral weighting for real assets, which historically has been, a good place to be. But we'll increase that higher, and we are doing it now in times where the hallmarks of things like persistent inflation are occurring. So it's not a perfect answer to your question, but it shows you that we've given a lot of thought to the whole asset allocation process, and to merely to own stocks and bonds, we've never thought that was a proper asset allocation decision.
Okay, perfect. Another question for you, John. Actually, this pertains to Duke. A gentleman named David Wachter wanted to know did you go to Coach K's last game in Cameroon?
I can happily say I did not, but I did watch it, and I decided we made a decision actually that tickets were really price were crazy, and so what we ended up doing is donating our tickets to a foundation to support athletics at Duke. So that worked out great for the foundation, and it worked out great for our fragile basketball psyches, which we didn't have to take a loss. Having said that, I'm really bullish about the postseason, and I think these are anytime you lose inside the regular season, it's probably a learning experience for something else, and hopefully there won't be any more.
Okay, very good. So let's see. Next question for you, Nick, that came through again was when you were speaking about the process, how often are the actual equities adjusted in here, and what's the current number of holdings?
So the equities are adjusted. So the scores are produced quarterly. So it's reconstituted and rebalanced quarterly, and it holds up to 75 holdings depending on scoring. It could be less, but typically we'll hold about 75 positions.
Okay, super. Next question here. This one comes to you, John. Is there a tactical component inside of DFRA?
There is not, although I can say this. The way we kind of look at that is, typically there's a broader ban in what I call non-correlative markets versus correlated markets, so that you could own, for example, in say neutral times, you own maybe 10%, maybe less. And then you could ramp that up in times of inflation. Or now, for example, where there's really low interest rates and you're not getting, good returns from some of your other fixed income assets. That's another reason why you might want to raise that up. So I guess the short answer is we're pretty much built to have a persistent allocation, even if it's really low. And because we have rules, that will take us out on some of the stock and bond products. But this one we chose since we've already historically had so much practice essentially in having exposure, putting a lot more on. We just felt like there was no real need to have the switching, because we will kind of take that care of itself in our our investment committee meetings.
Excellent. Okay, well, that concludes the questions for today's session. Certainly like to thank again everyone for joining us this afternoon. If you would like these slides, we can certainly get them to you. Please do not hesitate to reach out to us, as we'll be reaching out to you to follow up and getting some further water under the bridge with DFRA. And with that, thank you to both John Forlines and Nick Lobley for the excellent product and certainly the presentation today.